You sold one put contract. One. And you woke up the next morning to a $4,500 charge in your account and 100 shares of stock you didn't ask for. That's assignment. And if you didn't know it was coming, it can feel like a gut punch. So today we're going to break down exactly what happened, why it happened, and how to never be caught off guard by it again. Welcome back to Chalk Talks with Coach B. All right, if you're brand new to options, go check out the Options Basics playlist first. I'll link it in the description. This episode builds on cash secured puts and covered calls, so having that foundation is going to make this a lot cleaner. And as always, if you've got questions, drop them in the comments or find me on the stream. Let's get into it. Here's the one sentence version. When you sell an option, the buyer on the other side has the right to exercise it. And when they do, you have the obligation to follow through. You don't get a say. That moment when the buyer decides to use their right, that's exercise. When the broker matches it to you on the short side, that's assignment. Two sides of the same coin. Now, most of the time, buyers don't exercise early. They just sell the contract. But at expiration, that's where the automatic rules kick in. And that's where a lot of beginners get surprised. Here's the rule you need to burn into your brain. Any option that expires in the money gets auto-exercised. The Options Clearing Corporation does it automatically. You don't have to do anything, and the buyer doesn't have to do anything. If your short option is in the money at the close on expiration Friday, you are getting assigned, period. And one contract always equals 100 shares. That's not negotiable. One put equals 100 shares. One call equals 100 shares, which means the math gets real fast. Okay, let's walk through the exact example I described at the top. Say you sold the 45 put on a stock that was trading around 47. The stock slides into expiration. It closes at 43. That strike is now $2 in the money. Auto exercise kicks in. Here's the ledger. You are now long 100 shares at $45 a share. That's the strike you sold. And your account just got debated $4,500 for those shares. But wait, you collected premium when you sold that put. Let's say you collected $2. So $200. That goes against your cost. Your actual cost basis is $4,300 or $43 a share, which not coincidentally is right where the stock closed. So you're not underwater yet. You're essentially even with 100 shares you now own. The premium softened the blow and brought your effective entry down to exactly where the stock is trading. But you still have to have that $4,500 in your account to cover it. That's what cash secured means. You set that cash aside when you sold the put. Right. So if you ran this properly as a cash secured put, you knew you might end up with shares. You planned for it. That $4,500 charge is not a surprise. It's the trade working exactly as designed. Okay. Now let's talk about what can go wrong, because there is a scenario that catches even experienced traders off guard, and it has nothing to do with expiration. Early assignment. This is most common on short calls, specifically around ex-dividend dates. Here's the scenario. You sold a covered call. The stock is in the money, and the ex-dividend date is coming up in a few days. The holder of that call might decide it's worth more for them to exercise early, grab the shares, and collect the dividend themselves, so they exercise. Boom, your shares get called away early, days before expiration without any warning. This doesn't happen all the time, but it does happen. And if you didn't account for it, you can find yourself flat your position right before a dividend you were counting on. The fix. When you're short a call that's in the money and an ex-dividend date is coming up within the expiration window, be aware. You may want to close the call early to stay in control. All right, let's zoom out. The biggest mindset shift here is this. Assignment is not always bad. If you sold a cash secured put on a stock you actually wanted, getting assigned just means you bought it at the price you agreed to. That's the plan working. The premium you collected lowered your cost basis. You owned something you wanted at a discount. The place it hurts is when the stock keeps falling after you're assigned. Say that stock that closed at 43 keeps dropping, goes to 35. You bought at 45, the stock is at 35, so the position is down $1,000 gross. The 200 in premium softens it to 800 net, but it doesn't dig you out of that hole. That's the real downside. Assignment puts you in the trade. If the stock keeps moving against you, you own the position. So the rule here is the same as the wheel. Only sell puts on stocks you'd be comfortable owning at that price because there's a real chance you're going to own them. Let's do a quick hit recap before we close out. 1, the buyer has the right. The seller has the obligation. When the buyer exercises, you get assigned. 2, In the money options auto exercise at expiration. If you're shorting in the money contract on expiration Friday, you will be assigned. No exceptions. 3, one contract equals 100 shares. Plan your cash or shares accordingly. 4, early assignment is real, especially on short calls near an ex-dividend date. Know when the ex-div is before you sell a call. 5, assignment isn't the enemy. Being assigned on the wrong stock at the wrong price is. Be intentional about what you're selling puts on. That's it for today. If you've got more questions about assignment, or if you want me to cover rolling options when you're about to get assigned and don't want the shares, drop that in the comments and I'll make that video next. Hit that like and subscribe. Linked in the description is everything from today's episode. Good luck in the markets, no matter what stock you're into.